Hey everyone, welcome back to the channel. It's Will Hinder, financial planner and IRS enrolled agent here. And I was talking with a potential client the other day, and she brought up a question that honestly doesn't get asked enough. She asked, I have a full-time W-2 job, but I also run a consulting business on the side. Can I max out my company's 401k and a self-employed plan in the same year? And great question. The short answer is yes, you can under the right circumstances. There's some key rules and limits you need to understand to do it right. So let's break them down. But first, make sure you smash that subscribe button for real financial planning strategies to help you lower taxes, invest smarter, and make work optional. All right, we're going to get a little bit in the weeds here, but there's two main limits you need to know about, and they come from two sections of the tax code. Number one is the 402G limit, and that's your employee deferral limit, which is the amount you can contribute from your own salary to retirement plans like a 401k, 403b, or simple IRA. And in 2025, that limit is $23,500 plus a $7,500 catch-up contribution if you're age 50 to 59, and a super catch-up contribution of $11,250 if you're age 60 to 63. And this limit is per person, not per plan. And second, 415C, that's going to be your annual additions limit. It caps the total contributions an employer can make to a plan. And for 2025, that's the lesser of 25% of your compensation or $70,000. But here's the catch. You only get one 402G limit across all of your salary deferrals, but you get a separate 415C limit for each unrelated employer. But here's where it gets interesting. Your side business and your W-2 employer are two completely separate entities, at least as long as there's no control group relationship between the two. That means each one gets its own plan, its own contribution limits, and its own testing requirements. And since your side business is technically a separate employer from your W-2 job, that means each can have its own retirement plan, and each plan gets its own 415C employer contribution limit. All right, let's look at a hypothetical example. Let's say Betty, age 52, works at a W-2 job for a large company. She maxes out her 401k at the $23,500 per year, plus the $7,500 catch-up contribution since she's over 50. She also gets an employer match and profit sharing, and this brings her total contributions to the 401k up to the max of $77,500 due to her catch-up contribution. Separately, she runs a successful side business doing consulting work and wants to start a self-employed retirement plan. Even though she's already contributed the max employee salary deferrals at her W-2 job, she can still make a max SEP IRA contribution from business income, since SEP IRAs only allow for employer contributions. So the SEP contribution won't affect her employee $31,000 401k deferral limit at her normal job. And she could also opt to use a solo 401k and make only employer profit sharing contributions, since again, these would be employer contributions and don't count towards the limit for making employee 401k contributions at her W-2 job. But for this example, we're using the SEP IRA to keep things easy. In using a SEP IRA, she could contribute 25% of her W-2 wages if she's an S-Corp, or 20% of business net profit if a sole prop, subject to the overall $70,000 cap. And since SEP contributions are employer only, there's no option for catch-up contributions. And Betty's consulting gig had a banner year, and due to her earnings from her consulting business, she was able to contribute $70,000 to her SEP IRA, bringing her total combined 401k and SEP IRA contributions for 2025 up to a potential max of $147,500. So, yes, if you've got a W 2 job and a side hustle, you can save for retirement in both places. Max out your 401k at work and still make employer SEP contributions from your side business income. And when you understand how these limits work and how to coordinate employee versus employer contributions, you can seriously accelerate your retirement savings. Just remember that your total salary deferrals across all plans share one 402G limit, but each employer gets its own 415C annual additions limit. And that's exactly what makes this strategy so powerful. If you want help designing a contribution strategy that maximizes both sides so you can make work optional even sooner, grab a spot with me using the link in the description. See you next time.